Imagine it's 29 June 2015. You are a 42-year-old pharmacy owner living in Athens, Greece. Your shop sits on a side street not far from Ammonia Square, with 2 glass shelves of baby formula, blood pressure pills behind the counter, and a notebook where you still write down what regular customers owe. You and your wife have some savings in the bank, not much, but enough to feel responsible rather than rich. And you have spent years believing that money in a bank is safer than money in a kitchen drawer. Each morning you lift the metal shutter, sweep the dust from the doorway, count the cash in the till, and listen to old men argue about politics while waiting for prescriptions. Your rent is paid, your daughter is due back from school in an hour. Your supplier says the next delivery will come on Wednesday, just like always. Nothing in your tiny shop looks dramatic. That is the point. Most collapses do not begin with flames. They begin in places like this, where normal life still seems to be winning. If you have ever wondered why ordinary people are so often shocked by economic collapse, even when the warning signs were already there, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before, and it almost always begins quietly while the surface still looks calm. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then your phone starts buzzing, a neighbor tells you the banks are shutting, another says the ATMs are already crowded. By noon, the television confirms it. On June 28th, Greek authorities announced a bank holiday after the European Central Bank refused to raise emergency support. Cash withdrawals would be limited to 60 euros a day per card. Across the country, people who thought they had access to their own money discovered that a bank balance and usable cash were not the same thing. That moment did not arrive out of nowhere. Greek banks had already lost 47.6 billion euros in deposits from December 2014 to the start of the bank holiday, about 27.5% of their deposit base. The break did not happen in a single day. The break was simply the day the hidden stress became visible. And that is what this video is about, not prophecy, not panic, pattern recognition. History shows that before every major economic collapse, whether in Argentina, Thailand, Weimar Germany, the United States, Cyprus, or Greece, the same few warning signs appear again and again. The names change, the currencies change, the politicians change, but the structure underneath stays strangely familiar. Before we go further, there is something important to understand. Economic collapse is rarely a random explosion. It is more like a bridge carrying more and more weight while the bolts inside begin to shear one by one. From a distance, the bridge still looks solid, cars keep crossing, streetlights still glow. But inside the metal, stress is building. An economy works on promises. A bank promises that your deposit will be there when you ask for it. A government promises that its currency will hold value. A borrower promises that future income will cover today's debt. None of those promises are dangerous by themselves. Modern life depends on them. The danger begins when the promises grow faster than the real things underneath them, faster than wages, faster than exports, faster than tax revenue, faster than the production of actual goods and services. That is the secret key that unlocks nearly every collapse. Too many claims, not enough real support. Think of it like a town handing out tickets for bread. At first it works. Each ticket matches a loaf. Then more tickets are printed, more loans are issued, more deposits are created, more assets are valued, as if tomorrow can never go wrong. The bakery has not doubled, the wheat has not doubled, but the claims on the bread have multiplied. For a while, nothing seems broken because most people do not try to claim everything at once. Then confidence slips. Suddenly, everyone wants cash, dollars, gold, food, fuel, or simply a way out. That is when the shortage is revealed. Across history, 3 warning signs appear before that moment. The first is debt growing much faster than the income needed to pay it. The second is a hidden mismatch, where banks, firms, or governments make short-term promises using long-term or fragile funding, often in a currency they do not control. The third is a story of false prosperity, usually driven by soaring asset prices, where rising house prices, stock prices, or a strong exchange rate convince people that risk has disappeared when it has merely gone underground. Now here's where it gets interesting. These signs do not look frightening when they first appear. In fact, they often look like success. That is one of the reasons they are so often missed. The first warning signs of collapse are usually praised before they are feared. Easy credit gets called confidence. Rising debt gets called development. A strong peg gets called credibility. A housing boom gets called prosperity. The language matters because language can wrap danger in celebration. By the time people start using darker words, instability, panic, insolvency, the structure is often already weak. History keeps repeating this cruel trick. The warning sign arrives wearing the costume of a victory parade. The first warning sign is debt that rises faster than the real economy beneath it. Argentina is one of the clearest examples. In the 1990s, Argentina looked like a country that had finally escaped its old demons. In 1991, it pegged the peso to the US dollar. Inflation fell sharply. Foreign money came in. The banking system looked stronger. For a while, Argentina was treated as a model student, the kind of country international investors pointed to when they wanted proof that discipline could tame chaos. But look below the surface, and the beams were already bending. From 1995 to 2001, Argentina's public debt to GDP ratio rose from 35% to nearly 65%. Its external debt also remained heavy, and because exports were low, the country's capacity to earn the dollars needed to service that debt was weak. This is crucial. Debt is not just a number. It is a claim on future income. If your debt rises while your ability to earn shrinks, you are not building strength. You are building tension. That is exactly what happened. Brazil's currency collapsed in 1999, hurting Argentine exports. The economy contracted for 3 straight years. Tax revenues weakened. Unemployment rose. Yet the debt burden kept climbing. Investors began asking a deadly question, not whether Argentina was stable today, but whether it could still pay tomorrow. Markets have a cruel way of changing from patient to impatient all at once. Between January and November 2001, the yield on Argentina's 10-year government bond rose by about 20 percentage points to around 35%. That is the market's version of a scream. It meant lenders no longer trusted the promise. Once that trust broke, everything that looked stable started to wobble. People worried about the currency peg. They worried that banks with dollar liabilities and peso assets might not be able to meet withdrawals. Depositors started pulling money out. In December 2001, the government restricted bank withdrawals in what became known as the Corralito. Soon after, Argentina suspended payment on its external debt and abandoned the peg. By September 2002, the peso had depreciated 356% against the dollar over the previous year. Output was forecast to fall 15% in 2002, and inflation to hit 72%. But statistics only tell you where the storm moved. They do not tell you what it felt like to stand in it. For ordinary Argentines, the crisis ripped through daily life like a silent flood entering from under the door. The poverty rate rose from 37% in 2001 to 58% by the end of 2002. Extreme poverty, meaning not enough income to buy a basic food basket, climbed from 6% to 28%. Unemployment peaked at 22% in May 2002. About 825,000 jobs were lost between May 2001 and May 2002, and roughly 90% of those losses were in the formal sector. The stable jobs people thought were safest. Families changed their diets because they had no choice. Meat was replaced with soy, noodles, rice, and cereals. Milk and sugar were cut back. People delayed utility bills, sold belongings, walked instead of taking transport, and moved back in with relatives. Many middle-class households became poor for the first time after wages fell and savings were frozen inside the banking system. They were not reckless gamblers. Many had done what responsible citizens are told to do. Work, save, trust the bank, trust the currency, trust the rules. And this is where history gets uncomfortable. Argentina did not collapse because everyone was irresponsible. It collapsed because the country built a structure in which the promises kept getting larger while the real capacity to support them did not. It was like a family borrowing more each year while the main paycheck kept shrinking. For a while, the bills still get paid. Then one day the math arrives. This brings us directly to the second warning sign. Here is something I want you to think about before we go further. If a country looks stable only because money from abroad keeps rolling in, is it really stable at all? Or is it just renting stability? Drop your answer in the comments. Seriously. Because what I'm about to show you next is the part of this story that most people never hear, and it changes everything. The second warning sign is hidden mismatch. That sounds technical, so let's make it simple. A mismatch is when you promise one thing and fund it with something weaker. It is like building a stone house on wet cardboard. The walls look strong. The foundation is not. Thailand before the Asian financial crisis is a perfect example. In the decade before 1997, Thailand was one of the stars of Asia. Growth was fast. Investment was heavy. Money poured in from abroad. Bangkok's skyline climbed higher. Property boomed. Credit expanded rapidly. To many observers, this looked like modern success in real time. But a large part of that success was wired into a dangerous structure. Thailand maintained a currency peg that made the baht appear stable against the US dollar. That stability encouraged banks and companies to borrow abroad, often in dollars, often short term. Why not? If the exchange rate looks fixed, foreign borrowing feels cheap and safe. That is the trap, because if you borrow in a currency you do not control, you are only safe as long as the exchange rate holds and lenders keep renewing the loans. The moment either one changes, the debt becomes heavier in local currency terms, and the funding can vanish. By the mid-1990s, years of rapid domestic credit growth and weak oversight had created a pile of doubtful loans. Real estate markets were overheating. Current account deficits were mounting. Across Indonesia, Korea, Malaysia, the Philippines, and Thailand, the combined current account position shifted from a $54 billion deficit in 1996 to a $27 billion deficit in 1997, before flipping into surplus only after the crash forced painful adjustment. That tells you something important. The money was coming in fast before it rushed out fast. The region's apparent strength was masking a growing dependency on foreign money. The International Monetary Fund later described the crisis as a mix of overheating, weak financial supervision, and pegged exchange rates that acted like an implicit guarantee, encouraging too much risk. Then confidence cracked. After months of speculative pressure that substantially depleted Thailand's foreign exchange reserves, the country devalued the baht on 2 July 1997. The peg was broken, and once it broke, the mismatch that had been hidden in bank balance sheets and company debts became visible all at once. This is the brutal logic of mismatch. Yesterday's affordable foreign loan becomes today's crushing burden because the local currency has fallen. Firms that looked healthy can become insolvent, meaning unable to pay their debts almost overnight, not because their factories vanished, but because the numbers attached to those factories changed faster than their cash flow. The crisis did not stay in Thailand. It spread across East Asia. Malaysia, the Philippines, and Indonesia also saw their currencies weaken sharply. South Korea came to the brink of default. Capital inflows slowed or reversed. Investment collapsed. Some countries entered deep recessions. International support packages for Thailand, Indonesia, and South Korea eventually totaled $118 billion, with the IMF providing $36 billion within broader rescue efforts. Again, ordinary people felt the story in the body before they ever learned the vocabulary. In Bangkok, shops slashed prices in desperate attempts to pull in customers whose spending power had collapsed. Construction workers, shop clerks, and office staff who had lived through the boom years suddenly discovered that a skyline full of cranes was not the same thing as secure income. Across the region, banks came under pressure, businesses failed, and workers who had spent years climbing into the middle class found the ladder shaking beneath them. The crisis looked sudden on television. In reality, the weakness had been growing for years inside loan books, foreign debt contracts, and balance sheets few people ever saw. The lesson is simple and harsh. When prosperity depends on short-term foreign money and a fixed exchange rate, stability can be an illusion painted onto glass. It shines beautifully until the first crack. Then the whole wall goes at once. This leads to the third part of this story. The third warning sign is false prosperity built on asset prices. In plain English, this is when rising house prices, rising stock prices, or rising land prices convince an entire society that it has become richer in a deep and lasting way, when much of that wealth exists only because cheap credit is still flowing. The United States before 2008 shows this with almost textbook clarity. From 1998 to 2006, average home prices in the United States more than doubled. Mortgage debt of U.S. households rose from 61% of GDP to 97%. Home ownership climbed from 64% in 1994 to 69% in 2005. Housing-related sectors accounted for roughly 40% of net private job creation between 2001 and 2005. Read those numbers slowly. They describe more than a housing market. They describe an entire national story. Homes were not just places to live. They became machines for borrowing, spending, and imagining safety. Banks loosened standards. Subprime mortgages expanded. That means loans were increasingly offered to riskier borrowers, often with structures that looked manageable at first and dangerous later. Mortgage debt was packaged, sold, and spread across the financial system. The old idea that lenders should keep the loans they make was replaced by a conveyor belt, a moving walkway of risk. As long as house prices kept rising, the system seemed self-healing. If a borrower struggled, refinance. If a lender worried, sell the loan. If an investor wanted yield, buy the security. Rising prices covered every mistake like fresh snow hiding broken pavement. Then the snow melted. The housing boom peaked in 2006. In 2007, losses on mortgage-related assets began straining financial markets. In August 2007, investors started pulling back from asset-backed commercial paper because they feared exposure to subprime mortgages. That may sound like a corner of finance too obscure to matter. It mattered enormously. It meant trust was starting to fail inside the machinery that financed the system. Once that happened, the whole story of endless housing wealth began to reverse. Home prices fell by more than a fifth on average nationwide from the first quarter of 2007 to the second quarter of 2011. From peak to trough, U.S. GDP fell by 4.3%. The unemployment rate more than doubled, from less than 5% to 10%. And again, ordinary people learned the truth in the hardest possible way. Families lost homes to foreclosure. Workers lined up for jobs in stores because industries that had seemed permanent were suddenly cutting staff. The main asset of the American middle class, the family home, stopped feeling like a foundation and started feeling like a trap. A price that had once made people feel wealthy now made them feel exposed because they had borrowed against it. Now look closely at what happened here. The warning sign was not just high prices. High prices alone do not cause collapse. The warning sign was a society mistaking price for value and debt-fueled demand for durable strength. It was a prosperity built on a staircase that kept rising only because more leverage, more borrowed money, was being added to the lower steps. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. Argentina, Thailand, the United States, different countries, different decades, same result. In each case, claims on the future grew faster than the real ability to meet them. In Argentina, debt outran growth and export capacity. In Thailand, foreign borrowing and a fixed exchange rate created a mismatch between local earnings and foreign obligations. In the United States, housing prices and mortgage credit rose together until an entire financial system depended on the assumption that homes would keep getting more expensive. The same mechanism, different countries, different decades, same result. First, cheap money or trusted stability encouraged expansion. Second, leverage built quietly in places most people could not see. Third, confidence broke. And when confidence broke, people discovered that much of the system had been running not on cash, but on rollover, on refinancing, on the hope that tomorrow's market would still cooperate. That is why collapses feel sudden even when they are not. The visible event, the bank holiday, the devaluation, the foreclosure wave, is usually the snapping sound, not the years of strain beforehand. Collapse is not a lightning strike. It is a tree hollowing from the inside until the first hard wind. There is another pattern too, and it is one of the most counterintuitive facts in economic history. The period just before collapse often feels unusually normal. Sometimes it even feels prosperous. People see new buildings, strong asset prices, low inflation, easy borrowing, and reassuring officials. They mistake smooth surface conditions for structural health, but history keeps showing the opposite. A calm surface can hide a violent undertow. This is why official reassurance should never be the same thing as personal certainty. In almost every crisis, authorities speak the language of control right up to the edge. They do it partly to avoid panic and partly because they hope the system can still be patched. Sometimes it can. Often it cannot. The result is that the public hears calm words while the plumbing underneath is already leaking. That gap between language and structure is itself a warning sign. When a building manager keeps repainting the lobby while the basement is filling with water, the paint is not the story. At this point, the pattern becomes impossible to ignore. When debt rises faster than income, when stability depends on fragile funding or a peg, and when asset prices are treated like proof that risk is gone, history says the system has begun speaking in warning signs. And who pays when those warnings are ignored? Usually not the people who designed the structure. The human cost of collapse falls hardest on those with the least room to move. Look back at Greece in 2015. By the time the banks shut, the real damage had already been spreading for months. Deposits had been fleeing the system since December 2014. The stock market had crashed. Greek banks were forced to rely on emergency liquidity assistance, which reached 87 billion euros by the end of June 2015. When the bank holiday began, depositors still withdrew another 2.8 billion euros during the closure, even with the 60 euro daily ATM limit. Imagine trying to run a small shop, pay workers, or manage a household when your money exists on paper but drips out like water from a cracked pipe. Then look at Weimar Germany. In early 1922, about 160 paper marks bought $1. By November 1923, it took 4.2 trillion marks to buy $1. That is not normal inflation. That is monetary collapse, where the measuring stick itself is melting. Workers rushed to spend wages at lunch because by evening, the money could buy less. Basic goods became hard to secure, black markets spread, families lost lifetime savings, some people literally used worthless banknotes as wallpaper or scrap paper. Hunger, looting, tuberculosis, and higher infant mortality followed. When money breaks, it does not stay inside economics books. It enters kitchens, clinics, and childhood. Now look at Cyprus in 2013, a smaller country, but a brutally clear example of who absorbs the shock. Laiki Bank and Bank of Cyprus, the two biggest banks in the country, were restructured after losses on Greek government bonds and deposit outflows. Insured deposits were protected, but larger uninsured deposits were not. At Bank of Cyprus, nearly half of uninsured deposits above 100,000 euros were converted into shares. A survey later found that 55% of households in the sample suffered a direct financial loss. 28% experienced a bail-in of uninsured deposits. These were not abstract figures. They were business reserves, retirement buffers, university funds, and family savings accumulated over years. And this is where history gets most revealing. The people hit first are often the prudent middle, not the wild edge. Pensioners holding cash. Small business owners needing working capital. Salaried workers paid in a weakening currency. Savers who followed the rules. In Weimar, cash savers were destroyed, while owners of real assets sometimes preserved more. In Argentina, middle-class families were pushed into poverty for the first time by frozen deposits and falling wages. In Greece, it was not just financiers staring at screens. It was parents counting ATM withdrawals in 60-euro pieces. Collapse behaves like an invisible tax collector. It does not arrive wearing one uniform. Sometimes it comes as inflation, sometimes as devaluation, sometimes as bank controls, sometimes as foreclosure. But it almost always transfers pain downward and outward toward people who need money to function today, not people who can wait, hedge, or move. The historical record also shows something else. Those who come through these periods better are rarely the people with the best slogans. They are the people with the best margins of safety. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So, what did the survivors do differently? Not the lucky ones, not the politically connected ones. The people who simply came through with fewer scars. The historical record shows that those who came through these periods largely shared three characteristics. First, they were not over-leveraged. That means they had not built their lives on the assumption that smooth conditions would last forever. In the United States after 2008, households that were not forced to sell into the crash because their debts were manageable and they had some cash buffer, generally had more options than families whose entire future depended on home prices never falling. In every crisis, low flexibility becomes fatal faster than low optimism. Second, they owned or protected things with use value rather than just paper value. This is not financial advice. It is a historical observation. In Weimar Germany, cash savings were annihilated, while some owners of land, inventory, productive businesses, or foreign currency income were damaged less severely. One famous example was Hugo Stinnes, the industrialist who used debt and real assets in ways that allowed him to expand while cash savers were being erased. You do not need to admire him to understand the lesson. Inflation often punishes cash and fixed incomes first, while it treats debtors with real assets very differently. In Argentina, people with access to dollars, export income, or assets outside the frozen banking system often retained more room to breathe than families whose wealth existed only as domestic bank deposits. The counterintuitive lesson is that the most obedient saver in nominal money can be more exposed than the cautious owner of something real. Third, they moved early, sometimes before the danger felt obvious. That does not mean they predicted the future perfectly. It means they respected fragility. In Greece, families with some cash on hand, support from relatives abroad, or lower dependence on daily bank access were less cornered by capital controls. In crisis after crisis, the winners are not prophets. They are people who notice when a bridge is carrying too much weight and decide not to dance in the middle of it. There is also a human trait that matters more than most balance sheet ratios: community. During Argentina's collapse, families shared housing, food, transport, and informal work. During inflation and shortages in many countries, local trust sometimes lasted longer than institutional trust. When formal systems stiffen, informal ones often keep people alive. Collapse breaks contracts. It also reveals who still has relationships. So the real lesson is not about cleverness. It is about structure. Fragile systems punish dependence on a single promise. Resilient people, historically, spread their risk, limit their debt, and pay attention to incentives long before headlines turn dramatic. And that brings us back to the present. No serious historian should look at the modern world and declare that one exact crisis is about to repeat in one exact form. History is not a photocopier. It rhymes. It does not clone. But some of the rhymes are impossible to miss. Today, major institutions like the IMF and the Bank for International Settlements warn about stretched asset valuations, highly leveraged non-bank financial firms, fragile sovereign bond market liquidity, and enormous cross-border funding structures. By the end of 2024, the global foreign exchange swap market had reached $111 trillion in outstanding contracts. Private credit funds had grown to more than $2.5 trillion. The IMF noted in 2025 that US stock valuations remained lofty and that highly leveraged non-banks were increasingly important to market functioning. The BIS warned that shocks can now travel across borders quickly through funding markets and carry trades, meaning borrowed money can change direction with startling speed. That does not mean collapse tomorrow. It means the old ingredients, leverage, opacity, and dependence on confidence still exist in new containers. History's costume changes, its skeleton does not. Yesterday, the fragility sat on bank balance sheets and currency pegs. Today, more of it may sit in funds, swaps, repo markets, and giant sovereign debt markets that require constant buyers. Different plumbing. Same dependence on confidence. Same risk that a system which looks liquid in calm weather can become sticky and brittle under stress. The warning is not that the past will repeat line for line. The warning is that systems built on leverage still break in familiar ways. Now think back to the man in Athens. He did not need a PhD to understand what happened. He needed a supplier who would accept delayed payment, enough cash to keep the pharmacy open, and the emotional strength to tell frightened customers that, yes, he would still set aside their medicine until morning. His crisis was not measured in bond spreads first. It was measured in hours, in queues, in whether parents could buy antibiotics for a child before the ATM limit ran out. That is why these warning signs matter, not because history gives us certainty, it does not, but because history strips away the comforting lie that collapse is always unforeseeable. Again and again, the clues are there. Debt rising faster than income, stability built on fragile funding, asset prices mistaken for real wealth. The floor gives way only after the cracks have spent years spreading. So if there is one lesson to take from all of this, it is not to live in fear. It is to stop confusing calm with strength. Many societies do that right before the turn. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.